Welcome to Introduction to Mutual Funds, brought to you by Kanjo.com. Mutual funds are one of the most popular investment opportunities out there. A lot of people have them in their portfolios, but a lot of people also don't really understand them very well. And that's the goal of this video, is to provide you with the basics. So let's start by understanding what are mutual funds. Mutual funds are actively managed investments. A portfolio manager is going to buy and sell certain securities, and he's going to do this according to a document called the Mutual Fund Prospectus. This prospectus is a very important thing to look at. It talks about the sectors the mutual fund invests in. It talks about some of the restrictions placed on the portfolio manager. It's a really good place to start if you're thinking about investing in a mutual fund. Let's now talk about some of the goals associated with mutual funds. There are two major goals: providing diversification and enhancing returns. When you buy a mutual fund, you're buying a whole basket of securities. You're not just buying one stock or one bond. So a mutual fund does a good job of providing diversification. But as I'll discuss later, there is an alternative that provides diversification as well. And it's important to understand that there are other options out there. The second goal of mutual funds is to enhance returns. Because mutual funds are actively managed, the portfolio manager is trying to outperform the market, beat the market. And that is a goal of mutual funds. Whether or not they are successful in this is a whole different issue, but it's important to understand that is one of the most important functions of mutual funds. So now let's move on to fees. There are three major types of fees associated with mutual funds. There are sales loads, portfolio turnover costs, and annual fees. Sales loads are an upfront charge. So if I buy a fund, the sales load will be deducted from my total initial investment amount. A portfolio turnover cost is a fee that's charged for the transactions associated with the mutual fund. So for example, if a fund manager is buying and selling certain stocks, that will cost the fund in terms of trades, and those costs will be passed on to the mutual fund buyer. Finally, this is the big one, is the annual fee. Mutual funds will charge a percentage of the total assets invested. So for example, let's say a mutual fund charges a 1% annual fee and there's a $10,000 investment. 1% of $10,000 or $100 will go to the mutual fund every year. And here's the catch. The mutual fund gets paid regardless of performance. They get to collect 1% regardless of how well they do. That's something a lot of people don't know, and it's very important to understand. So mutual funds are an investment option, but it's important to understand there is an alternative. That alternative is index funds. I've created another video that talks about index funds. I recommend you watch it and try to understand it a little bit in depth, because it is a very good and inexpensive way to invest. Thank you very much for watching. For similar videos on this topic, I recommend you check out my website, www.kanjo.com.